20 questions, and let me start. Shalab Agrawal is asking that I'm a subscriber of the premium service. I understand, it's Value Research Stock Advisor, and I've been following the recommendations of Value Research team. I've invested in stocks, but I'm still very much scared to invest in direct equity. I've invested over 80 lakhs in mutual fund. Tell me a suitable plan to invest in stocks as well. Yes, there are some advantages, and you have achieved a scale whereby you can invest in, you should be investing in stocks. 3 important things which you must have. One is that you are interested in knowing things, you enjoy doing things. This is crucial because just thinking that we will give you a recommendation and you will invest, that is just the starting point, but that is not the end of the story. Because once you invest, stocks go up, stocks go down, and without understanding the reasons why they are going up or going down dramatically, till you read that, till you understand that, and till you buy into the idea, you will not be able to fully benefit from that. Stock investing requires a great deal of temperament, a very suitable temperament that and that can come only with understanding. So my plan for you will be that earmark something like, if you have 80 lakh rupees accumulation, think in terms of investing something like 10-12 lakh rupees over the next 1 year. Do it gradually. Even when investing in these stocks, don't try and invest at one go as you're getting started. It is important to develop your belief. Look at the best buy list there. You have about 12-14 stocks. Even from those 12-14, choose only 10. And look at it every day, which one you should be buying, how much you should be buying. Maybe you follow a formula that you'll be investing 10% of your monthly investment in those 10 stocks. Next month, just review that selection. Keep doing it. Keep it limited to best buys. Best buys is a good combination of stocks which are high quality. In fact, all the stock recommendations are of reasonable quality, but something could be more opportune. And we go about reviewing the best buys list every week. Though there may not be many changes every week, but we do take a very close look. We do a very close evaluation every week, just in case a change is needed. So start in a limited way. Do it for 2-3 years. And gradually, if you are investing 12 lakh rupees a year, 10-12 lakh rupees a year, then, in 2-3 years time, it will become 30-40%. You will have the confidence. And you will, and if you, after 2-3 years, if you think that, you are enjoying it, you are learning, you are believing, and you own the decisions, that is the added advantage, that is the added joy of investing in stocks. And you will be able to learn on the way because you need to diversify. You need to focus as well. You need to make your choice from the stocks that we are recommending. So this is important. So get started somehow in a limited way. And then gradually, once you have the confidence in 2-3 years time, you will have the confidence to move all your money that is there in equity funds into this. And you will also have a progress report of yours. How have your funds done over the last 2-3 years as compared to your stock portfolio? And monitor all these investments on Value Research Portfolio Manager. You can look at the performance for a defined time frame, this date to this date, how has your portfolio done as compared to the fund portfolio. You will figure it out yourself. I think if you do it in a calibrated way, the joy of doing it yourself, investing in equity for the long term, and learning on the way, I think there are advantages, and you have the scale to do it. Now I move to another question, a question which I was unable to answer last week. This is, and I don't know his name, but it was a sophisticated question. It was an important question which will be of interest to everybody. That I'm buying a term plan, and the insurance company is offering 3 different payout options. The first one, it says that sum assured will be paid as lump sum to the nominee. So something happens to you, all that is there in the term plan will be paid to your nominee. The second option, they will be paying some amount as monthly income for a period of 10 years over and above the sum assured. And in the third plan, they are saying that the monthly income will be increased every year by 10%. Which payout should I choose? So it's quite self-explanatory. The option 1, if something happens to you, your nominee gets all the money. Second option, your nominee gets a fixed sum, followed by some monthly income amount which will be given every month over the next 10 years. And he will continue to, he or she will continue to receive that over the next 10 to 15 years, which you can specify. And the third option is you will get some money and you will get the monthly income. And every year the monthly income will be revised by 10% or so. So it will be effectively, guaranteeing you many years of inflation adjusted return or income for your nominee. Which plan should you choose? It entirely depends on how confident are you that your nominee will be able to handle the situation. Just in case you are not around and your nominee gets this, assuming that one gets 2 crore rupees, will he or she will be confident of investing it in a manner so that one is able to derive the income with confidence, will have the discipline, will not fall prey to something which is too good to be true, where the money can actually go disappear, somebody fleecing that money. If you're not confident of that, if you can devise a plan for that and share it with the nominee, then it's fine, and you are confident that the nominee will be execute that plan well. If not, then the monthly income or the inflation adjusted monthly income will be a superior thing if you're not sure that it will be taken care of nicely. Simply because the whole purpose of buying this term insurance is to make sure that your dependents are nicely taken care of, and all the 3 plans can take care of depending on their situation or their ability to handle that money. Arvind Kumar is asking that I'm 70-year-old. I have 10 lakh investment in mutual funds, 8 lakh in debt mutual funds, 15 lakh in shares, and 15 lakh in public provident fund, and 5 lakh rupees in fixed deposit. Other than my cash flow from rentals or pension, I need about 15,000 rupees per month and 3 lakh rupees in emergency fund. With age, I want to be a bit conservative. Please advise how should I revise my asset allocation. So if you're looking at a conservative plan, I can assume that you don't want your equity to exceed more than 30% of your, that typically a third of your money in equity. And that is important because your ability to withstand or protect the worth of your capital can be derived only by investing in equity to a reasonable extent. And that could be a third of your money or 30%, 25 to 35% in equity. Use Value Research My Investments, the portfolio tracker. Put all your investments there, including your PPF, fixed deposit, everything. You will get your precise asset allocation. Upload all your investment, mutual fund investments from CAM statement, and put your shares investment as well. So you will get a holistic view of what you actually own and what is the proportion, what is the ratio, including you will get a sense of how your different investments are doing. And right now your equity portfolio is about, based on all the information that you have provided, is about 50%. So it will require, little reduction. And we are not taking into account your income from the house property. Because this pertains to the My Investment thing, the feature or the tool is only about financial investments. Consider your FD as your emergency fund. You have a meaningful amount there, and FDs, they're fixed deposit. They're called fixed deposits, but you can actually access your FD with a premature encashment in case of emergency. That can be taken care of by that. And I also want you to be, least, interventional thing. If you have a FD, it is important to, let it lie there. If it's an old one, you just might be getting higher return. So those are subjective things which you have to keep in mind. A monthly income of 15,000 from what seems to be a corpus of 50 lakh rupees works out to a little over, little less than 4%, which is quite comfortable. You can derive that thing. With all your investments, mount your systematic withdrawal plan. And before that, you have to make sure that, you have as much money in those investments, which can take care of, 3 years of income requirement is lying in relatively safe investments, so that you are not getting anxious with the ups and downs of the market. and rebalance your portfolio every year. Make sure that it's not exceeding 30-35%, and if it has gone completely out of whack with that ratio, then change allocation, move money from equity to debt or debt to equity, depending on the state of your asset allocation. Kumar A is asking that what is the difference between balanced advantage fund and aggressive hybrid fund, and which type of investor they are best suited for? They're quite similar, and they are, because of the evolution or the genesis of the mutual fund regulations, they look different. The balanced, the hybrid, aggressive hybrid funds, they started as balanced fund. They used to be, 51%, 49% into equity and debt. The tax rules changed and they became 55%, 45%. Then it became, tax rules defined that equity investment should be dominantly equity, and the tax treatment was very beneficial, so it all became 65%. So to comply with the tax laws, balanced fund changed their allocation to minimum of 65% to equity. Then the mutual fund classification became official a few years back, and the mutual fund regulations mandated that these aggressive hybrid funds, which came into being, they are, it is a wrong or a misleading nomenclature. They are not balanced fund. They are dominantly equity. So they provided for a mechanism that, okay, let's call it aggressive hybrid funds, and that is what they are called now. They should have a minimum of 65% equity and maximum of 80% into equity. So they are dominantly an equity fund, and modest amount of fixed income. They turn out to be relatively stable, and we quite like this fund for anybody who is getting started or little conservative for his growth investments. So so this is what is balanced fund. Balanced advantage is a slightly different, complicated animal. Balanced advantage funds also turn out, they are dynamic funds. They can actually change the allocation to equity or debt differently. And the balanced advantage fund, they also invest in arbitrage opportunity, which technically they are, by their character, they are fixed income, but by their design or for the tax treatment, they are treated as equity. So these balanced advantage fund can have 35-40% into equity, 35-40% into fixed income, and remaining into arbitrage position depending on their outlook of the market. So, and they change it dynamically. Most of these balanced advantage fund came into being to create a more conservative balanced fund, unlike the balanced, what used to be, what is now called the aggressive hybrid fund. And to get the tax treatment, it was primarily a tax dodge to derive the benefit of equity investment or the tax treatment of equity investment without being an all equity investment or a dominantly equity investment. So I would say that, if you're thinking of a long-term investment into equity and you are scared of the ups and downs of the market, go for the aggressive hybrid fund. If you want a more conservative take on that, go for the balanced advantage. Many a times, both the funds look alike. Mayur Ambekar is asking that our ELSS, equity linked saving scheme, the tax saving funds, are multi-cap funds. How to choose the best ELSS funds, and can you suggest few? Yes, all tax saving funds are multi-cap funds, and they are dominantly, they are equity funds and multi-cap funds, and the only difference is that they come with a 3-year lock-in period, and annual investment of 1.5 lakh rupee gets you the tax break under section 80C. You can deduct 1,50,000 rupees investment in such funds from your income for computing your taxes. Choosing the best ELSS, go to Value Research Online, click on that category in the fund category section, in the fund section, and you will get a good listing of 5-star and 4-star funds. That's the first place where you should start exploring. Choose from the 4 and 5-star fund. That's a good point to start. For specific recommendation, I can list some. I'm unable to recall them. Wait for our premium service, and or look for the best buy, best funds to buy, the book. Plus, you will also find in Mutual Fund Insight whenever we are dealing with the category of tax saving fund, which we did a couple of months back, you can pick the selection from there. Anup GS is asking that I'm investing 7,000 rupee via SIP in Motilal Oswal Multicap 35 for past 2 years. With so many people, asset manager and CEO quitting the AMC, and performance is not up to the mark, is it time to switch to some other fund? Yes, this has been relatively, disappointing fund. It started with a bang, and it did set up a whole notion of, a focus can actually bring about some advantage. There has been these changes. The fund manager has changed. Now the CEO has also gone. But, the CEO leaving definitely, is a leadership change. It might have some implication, but I don't think the CEO was directly involved with the fund management. He was more of a, interface with the investing community, in a sense that, their customers, their investors. Yes, it's a leadership change. But I would say that, this is a kind of fund which will do exceedingly well. I still like that fund. This fund will do, very well in a good market and remaining phase of the market. And this fund has had its share of mistakes, small mistakes, some not so, or it has been barely able to match the benchmark or, relative performance to other funds in the category. Is not very impressive over the last 3 years. Initial phase was outstanding, and which attracted a lot of investors. But I would say that, if you're looking at some good times in the equity market, this is the kind of fund which will do exceedingly well. Its focus, its quality is still very much in place. But yes, you have other alternatives to look for, though this fund remains a good choice, even now. Arnab Bhattacharya is asking that, has contra funds truly lived to its concept? Not many funds houses come up with contra funds. Is this indicative that the concept doesn't click, doesn't work? Yes, we have at Value Research, even the SEBI classification, the contra, the value fund have been clubbed together. And the whole category, India has been whenever the equity market has done well, growth has been the flavor and value has been out of favor. But some of these funds, very few of these funds are very impressive. When I look at, something like Invesco Contra or ICICI Prudential Value Discovery, and they had their lean period. These funds, many of these funds, they are in deep slumber. They are very disappointing. And most of the returns actually come in a fairly erratic manner and a sizable return. And that is what we have witnessed. This kind of fund requires patience. And many a times there could be a real test of patience because the relative underperformance. But most of the return, and that's the idea of a contra fund, that the fund manager is buying a stock which is generally out of favor, and he thinks very strongly about that, and he fills his portfolio with such positions, and as and when they gain favor, gain traction, these funds start doing well. So this could be this is a strategy which if you have a sizable equity fund portfolio, this is the kind of fund which should be, or a good fund of this kind should be 20-25% of your portfolio, because most part of the market, as I was telling about the Motilal Oswal earlier, and now this, is that there is a cyclicality in all the segments of the market or sub-segments of the market. Sometimes small cap do well, sometimes growth stocks do well, sometimes value stocks do well, sometimes mid caps do well. 2018 we saw that the large caps did well, and quite a small part of the large cap, 4 or 5 stocks of the Sensex were actually driving the market. So different segments of the market do exceedingly well at different point, and that is something which you have to keep in mind. You should have a diversified portfolio, and if it is representative of different kinds, something will come in handy if you are actually betting on mutual fund, because it is actually a targeted diversification of a strategy. So I would say that some of these funds are impressive. Mostly this category has been out of favor, and some of them are beginning to do exceedingly well. Ashok Sood is asking that in the current scenario of for a 52 plus year age person, where risk appetite is not very significant, for a period of 2-3 year horizon, which is better option, liquid funds or short-term debt funds? The idea is to maximize return with the relative comfort provided by debt or liquid funds. I would say 2-3 years time frame consider short-term debt fund. They could actually give you little more return than liquid fund. They are also reasonably liquid, but be extremely conscious of the quality of the short-term debt fund you are getting into. I'm 44-year-old. Raghunathan, this is a question from Raghunathan. This is a question from Raghunath. I'm 44-year-old and I'm investing in mutual fund, 1 lakh rupees per month, large, mid cap, small cap, index funds, and one international fund. I want to build wealth. How much can I expect the wealth in 10 years? Right now, investment in mutual fund is 35 lakh rupees. Use the go to Value Research online. Use the savings calculator on Value Research. It's a very useful tool. You can put this amount, and we have made a return assumption for the kind of investment that you are making, equity investments, and you will get a tentative, sense of how it will compound based on your 1 lakh rupees monthly investment in equity. And but don't take it as any kind of guarantee or indication. It could be substantially different. The assumptions of the system therein are pretty conservative, and I'm hopeful that next 2 years, next 10 years, we will have 1 or 2 big cycles. Right now, we are going through a cycle of recovery, and there will be a boom, and then there will be a bust, and maybe in 10 years' time you will see another boom, 2 booms. The returns could be very different. And when it comes to equity, most of the returns comes in a very narrow period of time. It is important for you to remain invested. Going by what you are stating, that an international fund, and I hope that it is meaningfully invested, because if you are choosing 5 funds, it is good to have an index fund for your large cap allocation, a mid cap fund and a small cap, so you are reasonably diversified. International fund, but make sure that these are 15-20%, and they are best of the class. And use Value Research to make your choice. Do a review, do an annual review of all your investments, and I think you will get a pleasant surprise. It's very hard for me to say, but going by your principal contribution is going to be 1 crore 20 lakh rupees, 12 lakh rupees a year, and I'm hopeful that you will end up being you will be beating the inflation and beating the fixed income by a wide margin if you remain a regular investor. Bevil Soares is asking that I write to you from Middle East and follow your advice closely on various mutual fund issues as well as investors face. My question is that is it possible to switch from a regular plan to a direct one on My Investment online portal, on your My Investment? No, Value Research is not in the middle of transactions as of now, and we don't intend to be in the middle of enabling you transactions very soon in near future. At some point, we just might consider it, but it is not a very difficult thing. One is that you can go to any of these online initiatives, ET Money, Paytm Money, and or Grow, Kubera. There are many such initiatives. And you can put your folio number, you can get your account statement uploaded, and they provide you a seamless switch from a regular plan to a direct plan. So that will save you money, and it can happen without much of a difficulty. Monitor all your investments at Value Research Online, because I think it is the best destination to track all your investments at one place. And when investing, as you have written to me, I would like to caution you on 2 things when you are switching from regular to direct. One is that be conscious of the exit load that will be applicable on your investments. For all your investments which are less than 1 year old, make sure that it is good to pass that 1 year, because that 1% deduction of all your contribution hurts your returns, and it reduces your capital. The other is that capital gains is applicable, short-term capital gains, and taxation at 15% of all the gains that you have, which is for investments made within the last 1 year. So be conscious of the short-term capital gains applicable, and you will be liable for paying 10% long-term capital gains even if you move your money from regular to direct, because it is considered as a redemption and a new investment, even though it can happen seamlessly through one of these platforms. So just be conscious of these 2 things, and it is a good idea because the expense difference in the 2 And if you are able to make your choice and do all these transaction enablers, use these transaction enablers, move your money from your bank to that and invest through them, you can save, the long-term impact of the expense difference could be quite meaningful. Pankaj Bora is asking that I want to invest in mutual funds aggressively through SIP for 5 to 10 years. I want to start with 5,000 monthly with increment of 10% per year. My aim is to build wealth in 10 years. Please give me some ideas for this. Portfolio build, I would say that, just wait for a short while. You will get a portfolio builder and which will help you build a great portfolio for yourself with this in mind, with precisely, 10% increment, how to do the rebalancing, make the recommendations, and everything customized to your requirement. It's coming soon, and we are working very hard to launch it. And use the funds to grow option on value research. Even today you have a simple option in the fund section, funds to grow, funds for growth. Use your selection from there, and I think that's a great starting point if you want to do it right away. Chinmoy Ghatak is asking that most agencies are projecting Indian economy is shrinking, such as CARE. They are saying that minus 20% year on year. Moody's is saying so, and but Nifty has recovered to 95% of its peak from February 20th. Is a correction expected soon? What is value search strategy to advise stocks in such unclear scenario? Very honestly, we don't know, and we are also quite surprised by what is happening. And we definitely did not expect such a sharp recovery, almost 95% recovery on the market. And the numbers that we are getting, the first quarter result, full quarter result that we have got, is quite disappointing. 49% decline in sales for the 1,000 companies that have reported their earnings. That is a huge decline. But everybody is of the belief that this is temporary. This will pass, and this will pass in 4 to 6 quarters. And I think we are approaching it that way. Besides that, the liquidity in the market, from the foreign investors, from the domestic investors, nobody is pulling out money. The market is going up, so that itself is becoming a self-fulfilling prophecy, because people are now fearful of taking that money out, because all the people who took their money out in the month of March or April, they are disappointed. So nobody knows. At Value Research, what we do, we don't do anything. We don't try to guess the market. We at Value Research, we think that most common investors are good to be investing. They should be investing their long-term money, the money that you don't need in the next 3 months, 6 months, 1 year, 2 years, 3 years. You should not be investing that money in equity in the first place. I don't invest my money which I need in the next 2 years or 3 years. Of course, I don't need to. But so if first is that the money that you don't need in 5 years and more should be invested in equity, so that it does not cause anxiety. Then comes, I think the level of it's very difficult to guess the state of the market. Then comes, choosing good fund for your long-term investment, and be extremely conservative with your short-term investments. As you would have seen in all the questions that I answer, that when it comes to equity, I don't mind recommending, the risky fund or the aggressive fund. But when it comes to fixed income, we just err on the side of caution, because that you can't really take chances with the money which you need after 2 months, 1 week, 3 months, 1 year, because and it will be for a goal which will be important and non-negotiable. So go with that. And about equity, I think there are great stocks. You would have witnessed that in the whole decline that we saw in the month of March, there are stocks which did not fall. They did not fall at all. In fact, on the contrary, most of them have actually gone up from there. There is an outlier segment. There are companies which do very well irrespective of the state of the market, and or their prices don't go down. In fact, we had a watch list of about 25 stocks which we wanted to recommend in Value Research Stock Advisor, and we had our price limits where we will be tempted to recommend them. And of those 25 stocks, we were able to recommend just 2 or 3 of them in the month of March, when the market fell so freely. A big decline, 20-25% decline overall. Still, many of those stocks just did not fall. And we did not get an opportunity to share those recommendations with our user base or our subscribers, simply because they did not come in our price radar. So there are great stocks, there are outliers, and at Value Research Stock Advisor, we are very focused on choosing a great company, which if you hold it for 5-10 years, you should be wealthy. And we will also go wrong with some of them, and we will go exceedingly, right, or we will get, some of those stocks can become very rewarding. There are thinking is that some great companies, if you get hold of them, ride your winners. So that's the kind of strategy which we follow. We don't try to guess the market, and I think it is not possible to guess the market where it will go in the short run. Arun Mohan is asking that I'm an investor who currently has about 50-50 mix of equity and debt. I want to rebalance it by investing more. I would like to add some gold as a hedge. How do I enter the gold market? I currently have only one mutual fund, so it is advisable to just go the gold fund way. Yes, if you don't have a demat account and gold fund, look for the least expensive gold fund, because gold funds might hide the expenses in a way that these gold funds invest in gold ETF, and the gold ETF will also have an expense. So look for the cheapest gold fund, and it will turn out to be, the largest gold fund happens to be the cheapest one. So maybe consider that, but make sure that why are you buying gold? Is it because it has gone up, or do you really want to keep 10% of your money or a defined amount of money in gold at all times? You are looking at it as an insurance to your overall portfolio. If you are looking at it as an insurance to your portfolio, by all means go ahead. If you are looking at gold because it has done very well in the recent past, that's a bad idea. Trying to ride a short-term momentum might disappoint you. Gold has lost many of the characters which it used to have 15 years ago. Gold has also become very volatile. Gold has become very pricey. And the volatility itself is also driving, and right now it has gone into a very different kind of self-fulfilling prophecy. The market has got, the price has gone up, more people are buying it, and that is driving up the prices even more. Gold imports in India carry that's another thing. They carry a customs duty of 12% or maybe 15%. I'm not a little sure, but it's some 12 or 15%. That customs duty actually make Indian gold a little more expensive than the global prices. So if it goes away at some point, the prices will fall by as much. So chasing the recent performance is not a good idea. If you want to have a defined amount invested in gold at all times, by all means do that. And to an extent that you want to de-risk yourself from catching a market high on gold, spread it over the next 6-8 months or 12 months. Sunil Jacob is asking that how is the best buy list reviewed? For example, there is a pharma company and which has already given 60% since our recommendation, but it is still a best buy at a price to book value of 11 times, which seems very expensive. Whereas a recently recommended gas company with a price to book value of less than 1 is not in the best buy. No, not true. You are referring to this pharma company. In fact, we recommended this company. It went, we have recommended in Stock Advisor this pharma company twice. Once we recommended when it was, and from that level it has gone up by nearly 3.5 times. And we recommended it once again. We re-recommended it after the price had doubled, and we were becoming little apprehensive like you, but now we have become more confident about this company. In fact, there is a possibility that if the price corrects for a brief period, we just might re-recommend the third time this company, even though it looks expensive, because this is a fast growing company. It has added capacity. And we think that this could be on, the outlook for this company looks very bright, much brighter than it used to be. It has resolved most of the problems most expeditiously. For the first time, after many years, this management came to clarify and report all the things that they have done. They have added significant capacity, and it was getting constrained by its capacity. It was, all its capacity was fully utilized. So in that sense, we are extremely upbeat on this, and we don't sell our winners. If we think that, this, just because it has become expensive, we are normally averse to, taking a short-term view. The stock advisor is not going to give you trading tips that sell it now and buy once again after 6-8 months, because that causes a lot of anxiety. This is a stock worth holding for next 4-5 years, unless some, of course, all the riders, all the things, things don't go the way you plan many a times. But this company is proving us to, it is showing all the variables, which makes us even, very optimistic about this company. About the gas company you are referring to, we like it for its dividend yield. We think it's a very significant company. We don't like it because it's there's something we don't like about this company because it's government owned. We generally don't like government owned. We don't like government as the owner of these businesses. But this company has, such a competitive advantage, very difficult to replicate. A compelling dividend yield of 8.5%, a business which is actually guarded from and it's a safe investment. I'm hopeful that this should turn out to be, but I think the pharma company I will still err on. I will think of it very compelling. Why it is not part of the best list? It is on the best buy list. Consider our two most newest recommendation as part of the best buy list. Subhajit Mondal is asking that I want to know whether the return of any mutual funds are being shown on value research platform is inclusive of the expense ratio or not. Should I remove the expense ratio from return to calculate the real net return? No. The net asset value of mutual fund is calculated after deducting the expense ratio. Expense ratio is reported to you just for sake of reference, and the calculation of returns for calculation of return on value research is on a NAV to NAV basis, because mutual funds NAV is the basis of pricing. So you don't have to do any adjustment. When you see a 1-year return of 15% on any mutual fund, you actually earn 15%, because if you would have invested 10 rupee 1 year ago, today the NAV is 11 rupee 50 paisa. Your return is 1-year return is 15%. 15% return is after adjustment of income of expenses from the NAV itself, so you don't have to do any adjustment. If at all you have to do some adjustment, do the adjustment for the long-term capital gains or short-term capital gains, because if you earn 15% and if it is in less than 1 year, you'll be liable for 15%. So tax-adjusted return could be different. If you hold your investment, for 1 year, and from that calculate, deduct the 10% long-term capital gains which you'll be liable to pay. But expenses, you don't have to bother. Mutual fund NAVs are post-expense. Shilpa Joshi is asking that planning for retirement 1 year from now for SWP for regular income, which forms 50% of total monthly income expected. Please recommend 3 funds for building corpus. Also, should I invest in LIC annuity and fixed deposit for the other 50%? Also, tell us about your premium service feature currently subscribed to Stock Advisor. Yes, we are working very hard to launch the premium service. It's undergoing testing, and there are a lot of issues which we are trying to resolve because we don't want to give you a negative surprise. Premium service will be able to give you a very nuanced recommendation or of your portfolio, which will be customized to your requirement. It will give you a lot of inputs in terms of best funds to buy if you want to build your own portfolio. It will also give you some enhanced feature in the portfolio manager, whereby you can review all the investment that you already have, which funds are worth holding, which funds are worth selling, which funds are which funds are the finest fund, which we also recommend, and which are the funds which you should, on which we do not have an opinion, and we will tell you the reason why we do not have that opinion on them. So the portfolio, my investment will be enhanced. You will get a recommendation, and not only that, we will have a number of mutual fund analysts who will be keeping an eye on all the funds that we are recommending, so that when things change, we can get back to you. Because making investment is one thing, keeping an eye on those investments very closely and being accountable to answer you and to tell you as and when some intervention is needed is just as important. So you will be effectively, by subscribing to the premium service, you will be effectively, accessing a very professional service, which is mostly available to professional large institutional investors to individuals, and it'll come in very easy format. You have been used to using the value research portfolio tracker for my investment for 20 years. There will be great enhancement in that. There will be features which you have been asking, and we are we are enhancing it so that it makes your job of tracking, intervening in your portfolio. So it'll make a recommendation about a portfolio for your customized needs. It'll do a review of your portfolio. It'll help you. It'll give you all the confidence. And today there is a reason why you should be doing it. Many investors think that they are confident, but they don't have a reliable tool which will be doing their hand holding effectively. So this is designed with that in mind, and you will save a lot of money if you are actually seeking the advice of you are seeking the help of an advisor and investing through the regular plan. The cost saving of this by using this service will be enough to justify the subscription of this service. So now getting back to your question, SWP for regular income, yes, that's a right way to do. I would say that use the portfolio builder tool that as and when it's launched, because this will be able to give you a precise recommendation of how to spread your money. And generally speaking, when it comes to annuity, I'm a little averse to it, because annuities in India, whether it be they come in 2-3 formats, which is constant annuity payment. The return on them is very the mortality tables, if they get revised, they can come down even further. So I don't find them to be a very effective reward for the large accumulation that you put in there. So do your evaluation of the annuity, but my sense is that if you are careful about your systematic withdrawal plan, make that investment and do a periodic withdrawal plan. You can do without your withdrawal plan could be, and you are making some allocation to equity. It is effectively your variable equity, a variable annuity. It can go up and down a little bit, but I think you will have far greater control, and it will turn out to be a superior alternative to annuity available today. Kiran Krishnan is asking that there are concerns of equity mutual outflows in July, increases in mutual funds and debt, mutual funds, movements into debt fund, and many first-time Robinhood investors entering the stock market. Can you please throw light on seemingly divergent behaviors and the way forward is in current scenario of economy lagging the market? All of it is true, and you can do nothing about it. So ignore it. Do things which is in your control. Investors investing money, market going up, economy not doing well, companies reporting poor earnings. You have absolutely no control on that. You have a control that are you going to lose your job? Is there going to be a reduction in your income because the business that you work for or you run is not going to do as well as it used to do in the past? Maybe tweak those things, because that is absolutely in your control. You have a far greater estimation of things. At the same time, the market is not going down simply because everybody thinks that this is for next 4 or 5 quarters and things will bounce back. And we have come across this, the earnings report, the first quarterly earnings after this crisis started, and we see that real earnings have come down. But most managements actually give it a rider, except for some businesses which will be impaired or which will be hurt very badly, and it will take them a long time to recover. But many businesses we are getting back on track, and many businesses are hopeful, and they're witnessing that some of the disruptions are getting moderated or normalized. And so everybody is of the view that it's a 1-year write-off. 1 year businesses will not make money, but things will be back to same old ways of steady rise and growth from there on. So I would say that all of it is true. Focus on things that you control, and what part of your money you don't need for 5 years, 10 years. Invest that money into equity through mutual funds, through ELSS funds, or through a balanced fund or an equity portfolio, depending on how bad you're hurt by the madness of the market. So these are all different vehicles which gives you a different experience. If you get very anxious and if you're very worried about all this, aggressive hybrid fund is good enough. or a multi-cap fund or a tax saving fund is good way to start. Regularly investing is important. If you are fine with your equity portfolio or building a stock portfolio, you have the temperament, you enjoy reading our reports, you are willing to subscribe and spend some time, quality time on weekends reading that, go ahead and do that. But worrying about who else is doing what is not going to take you anywhere. Savita Devi is asking, oh, this is a very concerning question, that she is 76-year-old senior citizen. My broker, Karvy Stock Broking, which has put all my stocks in power of attorney account. Many shares like Shishai paper worth 3 lakh, they say, have been pilfered by NSDL. What should I do? Immediately file a complaint with SEBI with all the details of your demat account and making this claim that you did not do anything and this money has been stolen. These shares have been stolen and the investigation is on, and SEBI will make sure. I think SEBI has gone about resolving the issues of many investors so far, and I think they were there. But lodge your complaint immediately. And SEBI on its website has a system called Scores, where you can give all the details, your demat account, the name of the share, I'm hopeful that these things will get resolved in case for most investors. Sorry. Nanda Kumar is asking that what is the difference between Liquid BeES ETF and any liquid mutual fund investment? Which is safer to invest in for return higher than FT? Liquid BeES ETF is a liquid fund which is available in the format of a ETF, and the issue of it ETF is that you need you buy ETF the way you buy shares in your demat account through a stockbroker, and it is traded in the market, and they give you return but sometimes there could be a nominal difference in the NAV and the price. That makes it a little complex. For an individual investor, the charm of a liquid fund is its convenience, your ability to buy and ability to sell, and getting the money directly into your bank account. Here the money comes into your bank account through a broker, which might so you have to get used to it in that sense. I would say that if you're looking for a slightly higher return than a fixed deposit, consider a short-term debt fund or a liquid fund for convenience and greater liquidity as well, besides marginally higher return. Shalabh Agrawal is asking that I think I have I don't think I invested 80 lakh in. Okay, I think I have answered this question. Vinay V is asking that for first-time investor, I think Tier 2 account is better option than mutual funds because of lower cost, easier management. What is your opinion on NPS Tier 2 account, and would you recommend it over multi-cap funds, ignoring the cap on equity in NPS? Yes, even in NPS, NPS is becoming a good alternative. They are cheaper, they are diversified, they are transparent, they are digital. And now you can also go up to 75% equity. So for somebody who is convenient, who is finding it fine, but we don't have a long history of the Tier 2. They are pretty small fund. It has not gained traction. But I still feel the design of NPS is very effective. Low cost is likely to prevail, and everything else being equal, low cost translates into superior return. So you can well consider it, and for the convenience and also for many first-time investors, I would say that if you have money lying somewhere and you just move it into Tier 2 and take it out, this is one thing. With the taxation bit is still unclear after so many years of this going on, because there is no securities transaction tax on NPS. So I don't know how it is treated. Many people. There are still two thoughts, that you can treat it as a long-term capital gains or with indexation for holding for 3 years. There is no STT, so how can there be? So that bit is unclear. But I would say purely in terms of return for returns, it is proving to be a decent alternative to aggressive hybrid funds. And at Value Research, we monitor all the NPS funds individually, whether it be a central government plan or the state government plan or the the corporate bond or the equity or the government bond portfolio of tier 1 and tier 2. And if you want to mix and match all of it, not only that, my investments at Value Research, if you have an NPS account, whether it be a central government plan or a state government plan, take your statement out from your NPS account, upload it, and you will be able to monitor it very closely. And this, by virtue of putting this portfolio in my investments, you will be getting your aggregate asset allocation, all your investments at one place. So this is a great way of, and central government employees and state government employees, where the state government or your respective employers match your investment, 10% deducted from your salary, 10% matched by the government. So you just might come across this whole discovery that you have been investing, or there has been a 8,000 rupee deduction, but there has been a 16,000 rupees monthly investment on your behalf. And what is the worth of that investment? And so it could be quite awe-inspiring, discovering what you actually own by virtue of all these mandatory investment coupled with all the discretionary investment that you have. Do that and get back to us with any feedback on this particular feature of your ability to track NPS statements, NPS investments at Value Research. We have come across some users who have been all praised for the NPS monitoring or the aggregation into asset allocation. Thank you very much. Keep using, give your feedback so that we can improve it and sharpen it for your superior comprehension. So thank you very much. That's all from me this week. We'll see you next week with